Hey everybody, and welcome to the Ben and Boz Narrated PowerPoint series. We are up to Lesson 11, the Statement of Cash Flows. I'm Boz.
I'm Ben.
What's up today, man?
I'm just questioning things today, man.
Whoa, questioning things. It's good to have a question in mind.
Well, you always say I'm Boz, but my name is here first, so we should really just put your name first. That's what I'm thinking.
We had a long debate, Ben and Boz, Boz or Ben. It won out. Ben and Boz was more popular.
Today's kind of one of those deep thinking days, but
I think so.
The wives voted, and that's what they decided, so that's what it's going to be.
They did. Cash flows. I'm excited for a statement of cash flows because cash is where it's at.
Cash is where it's at, and as you'll learn, cash is king.
Yeah.
What I love about statement of cash flows is that it kind of summarizes all the other financial statements, pulls a little bit from everything, and
it does.
Puts it all together. So
I think you're taking this one today, aren't you?
Oh, I'm excited.
We'll take a nap.
Well, you know that. I'm very excited about my PowerPoint skills that have developed quite a bit over these series, actually. So let's start with an example. Best Buy is going to be our target company today, and we have their statement of cash flows. It's normally not broken up into two different sections that you see here. It's just so that it fit a little bit better. It's easier for students to see.
I think that was a great idea, Ben.
Wow, thank you. It is officially being recorded.
That's right.
What do you see here, Boz? What are some things that pop out to you about Best Buy?
Well, when I look at a statement of cash flows, I always, the first line is net earnings, the first line on the entire sheet. But then I also look a lot at, maybe the operating activities section. All right, and I want to see, are they generating cash flows from operating activities? All right, and they're actually doing that. They're generating $1 billion from operating activities. And then I see on the investing activities section, they are using those operating cash flows to purchase property and equipment, new stores, and furnishings for those stores.
But they do have a positive cash flow from investing, meaning they sold a bunch of investments. I wonder if they're doing more of like a longer term type play. Investments were doing well, they sold them, and they're going to use that to finance future purchases of property, plant, and equipment.
So I think in last year, obviously they bought a bunch of investments, and now they're selling. They're definitely selling some. And then the financing activity is kind of a sign of a healthy company. What are they doing? They're buying back stock. They're paying dividends, repaying some debt. That's what you would kind of expect of a large, established, healthy company.
So you're not concerned that Best Buy has spent $1.5 billion on financing activities?
I am not at all concerned. Healthy companies usually have a nice big outflow in financing activities. We'll learn a little bit more about that as we go along.
Cool. Yeah. Thank you for taking us through that. I appreciate it. A couple of things I wanted to highlight here. We have three big sections on our statement of cash flows. Operating activities, where there's a lot going on in there. Investing activities and financing activities. Then what we do is take the total of each of those three sections, and we can see over the last 6 months, Best Buy increased their cash by $768 million.
Yeah, and why we look at this, because if we just looked at their balance sheet, we could figure out that the cash went up by $768, but we don't know why.
Exactly. We want to know the breakout. Where did it go? What did they spend it on?
Yeah, because some increases to cash, we would argue, are good things. Some could be concerning things. We'll chat more as we go along.
You know the best part about the statement of cash flows, Boz?
I feel like I should know this.
It's the one I put the box around.
Okay.
We know if it's right away, because what we're going to do is take our beginning cash, add into all the changes that we hopefully explained in these three sections to see we get an ending number that should equal what we have on the balance sheet. If it does, great. We could have still messed some stuff up, but we probably captured everything.
That's true.
If it doesn't, then we know. Wrong. Yeah, we got more work to do. So that's, I guess, one thing that's kind of nice about this is if it's right at the very end.
That's true. Well, I'm happy now. I know what the best thing is about.
Now you know the best thing, and that's not an opinion. That's a fact. Nice. So, overview. What are we going to be doing today? Number one, understand the purpose of the statement of cash flows, and make sure we're good at all three of those sections: operating, investing, and financing. Understand how to categorize accounting information into those sections. Understand how to calculate the changes to actually come up with the amount that we see on the statement of cash flows. And understand how to put it all together. Finally, the last thing, understand how to interpret the statement of cash flows. We'll do that at the end. But Boz, I think there's something more here.
There's a lot of C's in those overview. Bullet 2, 3, and 4 all have a key C in there.
No way.
It's almost like you should highlight them.
Oh, wait, there's one. There's another one. And It's like the 3 C's of the statement of cash flows.
Everybody, Ben's really proud of this, so please pat him on the back virtually online here.
It is my patented method for creating the statement of cash flows that is not actually patented, but we're going to, when we get to it, ultimately categorize everything first, then calculate, and then we just create by putting together the different categories and the amounts that we calculated. So 3 C's, the statement of cash flows.
That's awesome. I'm proud to be your friend.
Thank you. Appreciate that. All right. So first of all, before we get into how to actually create it, our main question should always be, why do we care, right? Why is it important? What's the big deal about the statement of cash flows? And Bob, what did you say about cash earlier? You love cash?
What did I mean? I
it was
love
it
cash
was like
flows.
2 minutes ago.
Cash is important, and whatever I said, you edited me and said cash is king. I do remember that.
Hey,
part,
there it is. Cash is king.
And that's a phrase we get from the business world. That's what they say. I mean, what that means is net income is not the most important thing.
Yes.
You know, I'm getting hungry. It's kind of close to lunchtime. After we record this, I'm going to go grab some lunch. I'm not going to walk into the campus cafeteria and hand them a sheet that says, "Here was my net income for the last year. May I please have, a sandwich?" They'd say, "What is this? I need some cash."
Can you do that?
You can't. You can't hand them a sheet that said, "Here's my net income. I want a sandwich."
I want you to do that.
It's just an accounting concept.
And I hope there's an accounting major working the till, and they say, "Great, here you go, boss."
Okay, we'll try it.
Anyway, yeah, like Boz was saying, income statement, that's on the accrual basis. That's what we've been learning up to this point. But investors do want to know what actually happened to cash. And the biggest thing, it's absolutely possible for us to have an income statement with a positive net income, but a statement of cash flow is going to show cash went down. So maybe there was a big non-cash operating expense, say like depreciation or something, that drove net income to be negative, but the company could have also generated positive cash flows from their operations.
Yeah,
so,
and again, that's not good nor bad. We just have to understand it and put it all together to then evaluate it. We'll talk about some of the good and bad possibly later on as well.
As an investor, I want to know, does the company have cash to ultimately pay me back? Can I get my money back? Can I get a dividend? Can they repurchase my shares? Whatever it is. So cash flows, it'll give investors an insight into where the company is spending its money. That's why we have the different sections, that operating, investing, financing, to help break it out in broad categories before we get down to the specifics. So then the last one, is the company generating positive cash flows that ultimately shareholders want to return? We need to get that. So one more little definitional type piece before we get into actually the operating and investing sections. Direct method versus indirect method. 2 different methods to calculate statement of cash flows. You get to the same answer at the end. It just looks a little bit different in the presentation. So under a direct method, a company is going to show all of the cash inflows and outflows. So some examples: cash received from customers, paid to suppliers, cash paid to employees, things like that, where if you don't have any sort of accounting knowledge, it is pretty straightforward. That is pretty useful. Under the indirect method, companies are going to start with net income, reconcile that to any of their changes in cash flow. So as an example, we'll have depreciation or changes in receivables, changes in accounts payables, and we're going to talk through these in a little bit more depth in just a second here. But you show a change in accounts versus just cash received. So Boz, what do you think? What do most companies use?
Well, I have never seen the direct method used in practice, so I'm going to go with indirect here. Do you agree?
I do agree, and
right.
I have seen the direct method used in practice, and that is because I Googled it and had to search for quite a while when I was creating this thing to find it, and that company was acquired. But I did find sometimes in the EU they use a direct method, but for the most part, companies, their systems are just set up. It's a lot easier to calculate once you have all the other accounting data to do the indirect method, and investors here know how to interpret it, so that's okay.
The EU, the European Union. If I ever go over there, start working, doing some work over there, I'll be aware.
You'll be aware.
Look out for this.
Probably don't watch this podcast though, this video, because we're gonna go over the indirect method. Yep. Whoa. We're a little off. We'll get there by the end.
Yeah.
All right. So let's jump into the very first section, the operating section of the statement of cash flows. A couple of pieces here. We show it first. It's always the first one. And it tells investors whether the company was able to generate cash from day-to-day operations. What are they doing on a daily basis? What are they actually in the business for? The main benefit of that, we don't have any of those peripheral activities. So say a company is in the business of creating honey and wax products, say like Trinket Honey LLC. On the statement of cash flows, the operating section is going to have any costs associated with that. But when I have all this excess cash that's coming in, I'm investing that.
All this excess cash.
I'm creating an image of success, boss. You're undermining it. That's okay, though. But when there is excess cash that comes in and I invest it, and I'm going to have some gains on investments, as an example, those are not going to go in operating section because it'd be misleading to investors.
Investors just might want to see separately how much are you generating from operations, how much are you investing back in the business or paying out to the shareholders.
You know what's cool about this section? We have a 1, 2, 3 process to get it done. So when we're actually creating the statement of cash flows under the indirect method, number 1, always start with your net income. That's the first thing.
That's cool.
You got that. You can find that on the income statement already. Mm-hmm. Number 2, add back adjusting items. This actually does trip people up sometimes. An example of an adjusting item is depreciation and amortization. That's the biggest one that we're going to work through here. If you look back to Best Buy, you'll see they have a lot more. But depreciation and amortization, we recorded an expense, so that reduced our net income. But did we actually have any cash on that, Boz?
No. Depreciation is a non-cash expense.
Exactly. Mm-hmm. So we should not have that as a reduction of net income for purposes of the statement of cash flow. And so that's an adjusting item. We would add back the depreciation expense, and that would bump up our cash flows from operations. Mm-hmm. And then number 3, adjust for any changes in current assets and current liabilities. And so current assets, let's just think about like inventory as an example. If my inventory goes up, so an increase in inventory, well, I had to pay for that somehow, right? Under this method, we assume that we paid cash for that, so I'm going to have a negative on my statement of cash flows for an increase in inventory.
But we didn't have an expense, yep. So
exactly.
It didn't decrease net income. And I'll say the vast majority of these are current assets and current liabilities. There could be a couple long-term in there, but that's a little bit beyond the scope where we want to go with this presentation.
All right, so up next, we have Boz's way of doing things.
Ben doesn't necessarily do this, so just really quick, if this helps you, when you're on the operating, the cash flows from operating activities, if this helps you remember it, we've got current assets and current liabilities, and they can either go up or down. So on the statement of cash flows, if your current
That's profound, Boz. Current assets can go up or down.
This is my minute, no interrupting. So if current assets go up, that is actually going to be a decrease on the statement of cash flows. If current liabilities increase, that's going to show up as an increase on the statement of cash flows. And then we flip those. If current assets go down or decrease, that's going to be an increase on the statement of cash flows. If current liabilities decrease, that's going to be a decrease on the statement of cash flows. And why that happens are a lot of the examples we're going to go through. So if that helps you memorize that, go ahead. If it doesn't, you can be like Ben and just make fun of me. So for coming up with that. Yeah. And with that, I'll turn it back to Ben.
Thanks, boss. I appreciate that. So this pattern that he set up, it absolutely works. It is correct. What I found when I learned about statement of cash flows is I just tried to memorize that, which didn't really help me in some of the other ones, like when I actually had to think through them. But it is a great way to get started, remembering liabilities move in the same direction, current assets move in the opposite direction. But let's put in an example here to help you figure this out. So we got a company, brand new. All the beginning balances are 0. They provided $1,000 worth of services on account during the year, collected $600 of it before year end, which gives us accounts receivable then of what, Boz?
$400. I'll do the math in our
head
here. I'll be here to help you.
Yeah, Boz is going to be the math guy this time. Companies also accrued wages expense of $200. Accrued means they haven't paid it yet, but they do owe those employees.
Debit wages expense, credit wages payable.
Nice. Way to go. So what do we have ultimately? $800 of net income.
The $1,000 minus the $200. Yep.
$600 of cash.
$1,000 on account, collected $600 in cash, which
so
left $400 of accounts receivable.
There we go. Yep. $200 of wages payable matched up there, and retained earnings just going to equal our net income. We don't have any dividends here. So if we were to create an operating section of statement of cash flows, Boz, you're on fire. Why don't you keep going with it?
Well, according to Ben's 3-step process, we're going to step one.
You can make fun of me for my processes. That's okay. Right. It's all fair.
We start with net income of $800, and again, we've already we've created an income statement and balance sheet, so we're just pulling information off of those two. So we pull our net income, step 1. And then step 2, we would add back non-cash expenses like depreciation, amortization. We don't have those actually here. So then we get to step 3. We look for changes in other current assets and current liabilities. Accounts receivable went up, all right, and that actually causes a decrease on the statement of our cash flows. And the reason is because those sales were in our net income, but we have not received cash for them. And then similarly, we add our increase in our wages payable because that wages expense decreased net income, but we did not pay cash for it. So we're starting with a non-cash thing like net income, and then we're ending up at cash flows. And there's the $600 we have. So we like that example just because it shows a current asset, it shows a current liability, and how we use those to reconcile from net income to cash flows.
And before you practice those two that Boz was explaining about accounts receivable and wages payable, that trips people up the most by far. So it is okay to take some time. It's okay if you're a little bit confused right now, but just keep practicing it. And that logic of adjusting net income to get to cash is really what hopefully will win at the end. So, all right, let's move on. That's the operating section. Investing section of the statement of cash flows. This one is usually a little bit more straightforward. It's the second one after operating. It tells investors how much the company spent on investments. And when we're talking investments, we're not just saying like stocks and bonds, right? We have a couple of different types. A big one is going to be property, plant, and equipment.
That is
so capital expenditures.
Yeah, that's probably one of the most important on there.
Yeah, it's what is the company spending? As an investor looking at this, what is the company spending to continue growth or drive future growth? And property, plant, and equipment would put that in. And then the other one, it can be cash flows from buying and selling stocks and bonds, other types of investments, stocks in other companies, bonds in other companies, things like that.
Or treasury bonds. Yeah, I mean, Apple was sitting on a couple $100+ billion of cash for a while, but they just didn't sit on the cash because that would earn very low interest. So they were buying government securities and other things. So in their statement of cash flows, they had some very large purchases and sales of investments. And I think the one we're missing on here, and I forgot, Ben, to bring this up to you, my bad, man, is like purchasing actually, well, we kind of cover that in short-term stocks and bonds, but big acquisitions of other companies or, assets or stock of other companies, more like from a long-term strategic acquisition standpoint. Kind of covered in that second bullet point, but just to kind of mention that as well. Yeah. When Amazon bought Whole Foods, Amazon has an enormous outflow in their investing activities then.
But does that concern you as an investor?
No, not as long as I think Whole Foods is going to make enough cash flows from operating activities.
Exactly, and that's the decision that you have to make. But I guess where I was getting to is that we're not necessarily afraid when we see a negative section or negative amount in the investing section. That's okay. We're all right with that.
We would get concerned if the operating section was negative after year.
Yes, so. Exactly. A trend, you only have so much cash, right? You can't afford to lose all of it. So, as an example here, company purchased short-term investments of $300, sold short-term investments of $200, purchased equipment of $75. And so what you've noticed is that we broke out when they they purchased and when they sold the short-term investments. That's because you actually have to show those separately on your investing activities section. You can't just go ahead and net them together. So, sorry, Boz, there's not a ton of math on this one.
I'll let you do it then.
All right. Safe. Thank you. So, the purchase of property, plant, and equipment, our PP&E account went up, but cash went down because we had to pay for that. So, the purchase is a reduction of $75. The purchases of short-term investments, again, investments went up, but cash went down because we had to pay for those investments. So we reduced by $300. But then when we sold the short-term investments, it went up by $200. Investments goes down, cash goes up. So we have a total cash flow from investing of $175. One last piece on this here. It says short-term. It doesn't matter if it's short-term, long-term investments, anything like that. Just investments in general are going to go into that investing activity section. All right, financing section. Boz, is this your favorite section, the statement of cash flows?
I don't think I have. I just love the whole thing. I don't think I have. I don't know why you make me choose a favorite section, man. I just love the whole thing.
So you're saying choosing sections is like choosing your favorite child?
Well, I have a favorite kid. So
do you want to share with everyone?
Yeah, I tell them it's whichever one is with me in the room at the time.
Oh, so, see, that's a good. Well, we're on financing right now, so is financing your favorite section?
I have a favorite fellow professor.
Yeah?
Yeah, it's you.
Oh, thanks,
as soon as you leave the room and someone else comes in, it's going to be that person.
I appreciate that.
So yes, financing is my favorite section.
Great. I'm going to roll with that because I don't know where else to take it. So financing is our third and final section. And there's a lot of different pieces that can go in here, but in general, it all relates to shareholders or creditors. What type of flows do we have relating to shareholders and creditors? So, Boz, what's some examples here?
Well, usually the first thing a company does is issue stock, right? So it's usually the first journal entry that you ever make. And eventually you may repurchase stock from those shareholders. And then you also might give those shareholders returns by paying them dividends.
I love dividends. That's great. It's like a paycheck.
And then the same thing with debt. You might issue debt, and then you might repay debt. All right. So it's basically getting money from and then paying money back to your investors and your creditors. The only exception, interest expense actually rose through the operating activities section, but pretty much everything else we're doing with our equity investors and our creditors, or lenders, that's going in this section here.
Yeah, and that is an interesting point you bring up with interest expense.
Interesting.
I didn't even miss that. Wow, that's great, Boz.
Yeah.
You're my favorite professor in the room right now.
I know what that means. In the room right now. So
I'm more honest about it. Transparency is important.
Yeah.
So interest expense, which is a cost of financing, is shown in the operating section through net income. It's just part of net income and a reduction. Whereas dividends, which is also a cost of financing, is shown in the financing section. And so I don't know. I haven't really found any great rationale for that. Have you?
Either. No. So it's just kind of the rules the way they are, at that point in time. So, but I think they could have put interest in the financing section, arguably as well.
I agree.
But they didn't.
So here's where we are. So let's do an example then.
That's right.
So financing activities. We have a company here that's issuing stock for $500, repurchases stock for $300, pays dividends for $200, issues bonds, meaning they're taking out the debt of $400, and repays bank debt of $100. So in this one, the first thing, we're just going to take it piece by piece. They issue the stock for $500. That's positive, right? When they issue stock, they get cash.
Debit cash, credit common stock.
There you go. When they repurchase stock of $300, what's going to happen for our entry?
Treasury stock and credit cash.
There you go. So it's a credit, meaning a decrease of $300. Payment of dividends.
Debit retained earnings, credit cash.
Boom. And proceeds from issuance of bonds.
Debit cash, credit, bonds payable, and maybe a premium or discount.
Oh, want to get into that?
No,
not right now.
Go back a lesson.
All right. And then repayments of bank debt. That's going to be, again, a repayment. So
debit, bank loans payable, and credit of cash.
There we go. Total then, we have cash flows from financing activities of $300.
It's almost like we need a big example to pull this all together.
I do think we need a big example.
Should have said that 5 seconds ago before we went to the slide.
Let's do a comprehensive example. And Boz, I know you said you kind of wanted to kick back and just listen to it, but I'm going to go ahead and guide us through this one, and then I want you to actually answer all the questions. How's that feel?
I've had enough coffee today, so we can do
You're ready to go?
Pretty good,
Your
actually.
energy level is pretty good today. So I like that.
Yeah.
For an old man, that's pretty good.
Old man. 46.
46. There you go. All right. So as you can see here, we have the balance sheet. And one thing I wanted to point out, that the balance sheet itself is not enough to complete a statement of cash flows. We also need a little bit more breakout. You could find this retained earnings activity on the statement of stockholders' equity. And then you could find some of like depreciation, amortization expense, sale of investments, things like that. You could find some of that on the income statement.
Yeah. So just some key things we're going to look at. So cash has gone down during the year of $750. We want to explain that. That's a big thing we're going to look to explain. Why did it go down?
Hopefully when we're done with this thing, it equals our ending cash and cash equivalents.
I hope so too.
That would be the goal.
I'd have to re-record this thing.
You ready to start?
Yeah.
Do you remember step 1 of the 3 C's?
Step 1 of the 3 C's. What is it? Like calculate, create, or categorize? Which one?
Categorize. Switched over.
Right.
Categorize. All right.
I don't use the 3 C's just like Ben doesn't use that one slide. But use what you want.
So we are going to take all of these different pieces that we have here and categorize them into their sections, either operating, investing, or financing. And when I say we, I mean Boz is going to go ahead and do this. So Boz, cash and cash equivalents. What's that one?
That's what we're trying to prove out. So we're going to give that a none, basically.
That wasn't even an option.
It wasn't. So,
but it's the right answer somehow.
Yeah. In short-term investments that would normally go in the investing activities section, we're going to call it none here, just because we both bought and sold some. So we're actually, you'll see why this is going to make sense in a bit.
Yeah, we have a breakout down here, purchase and sale of investments, so we can show it down there.
If all we did was purchase investments, we wouldn't have had that breakout below, and then we just would have said investing right here.
Exactly. So accounts receivable, Boz.
A bunch of operating ones now. Operating. 3 in a row.
And operating again?
No. In theory, equipment is more of an investing activity, but we're going to break it out below between what we paid for equipment and what we depreciated on our equipment. So let's just put none for now. Now we're going to do a few more operating.
Well, I'm excited to see where we're going to go with that equipment piece.
Oh, it's a fun one. Yeah,
it'll be fun.
So other, other current assets, current liabilities, those are operating.
And then we get to long-term debt. Not quite
Sounds
operating,
like
right?
transactions with owners and lenders, basically. So this must be financing.
Yeah, debt and equity. We think financing, which common stock fits in then too, is being
Also
financing as well.
Retained earnings, you usually think of, well, there's kind of components of that. There's the net income piece, and then there's also the dividend piece. So let's just put none for that because we're going to break it out below.
Hey, net income right here.
It's next. Now that's your operating thing. That's
in fact, it's
step
one
in
of
your
operating
activities.
Good. And then dividends paid. How about that?
That's in your financing activities.
That's in our financing.
Transactions with owners.
All right, perfect.
Yep.
And then now we're getting back into that equipment you set up above. We're going to break it out into depreciation expense and purchase of equipment.
So depreciation, step 2 in the operating section, and then purchasing is in the investing section.
What if we had a sale of equipment?
If we had a sale of equipment, so that gets more complex at that point in time. There'd usually be some sort of gain or loss that we'd have to account for that in the operating activities section, and then the sale of equipment would then go in the investing activity section.
There you go. Back out the gain or loss from operating, and the actual cash you got from selling it goes into investing.
Then purchasing some investments, that's just investing activities.
See what my key for remembering those? It says investments.
Yeah.
that's what's helpful for that.
You'll like that, especially as you get older, man.
All right, boss. So we had 3 C's, and we did categorize. What's the next C?
Well, it's either going to be create or calculate. I'm going to go with calculate.
Calculate is correct. You nailed it. There you go. So we have our summary so far, same set of information. We've categorized everything, and now we have the difference in accounts. So we need to show for anyone where the category is not none, right? If it says operating, investing, or financing, we need to show the amount that we're going to show on the statement of cash flows.
So we're going to skip the first 2 because it's.
Do you have your handy chart out right now? If current assets go up or down,
is in my mind. Man.
Is it?
Because the first one is accounts receivable, and they're going up. That basically meant we booked revenue, but we didn't get cash. All right, so we're going to show a decrease on the statement of cash flows.
Yeah, net income is higher because revenue was higher in theory, and we didn't get the cash. All right.
Inventory, we paid cash for it, but we did not record an expense yet because it's not sold. So that's the way that one's going to be. That one will be negative as we build up that inventory.
Exactly right.
Okay. Again, there was no expense that drove down net income, but there was a cash outflow.
Good.
Other current assets look like they're going the other way, so that'll be a positive $100. That could be prepaids or something like that in there.
Yeah, where we would have recorded, say it was like prepaid insurance as an example, and we already had the asset for $300 in 2017, and we used 100 of it in 2018. So we recorded an insurance expense, which reduced our net income, but we didn't actually pay any cash in 2018.
Insurance expense, credit, prepaid asset. It drove down net income, but no impact on cash flows, so that's why we would show it as a positive here.
Exactly. Skipping equipment, right? Because it's a none. We're gonna again break that out down below. Accounts payable. So it was 12,000. Now it went down to 11.
Yep.
Do you want to take that one?
Well, we debited accounts payable. We credited cash. All right. So net income was not decreased, but cash did decrease. And because we start with net income, we need to show a decrease here because we truly did decrease cash.
Exactly. Accrued salaries.
That was kind of like the example we went through in the operating activities section.
Exactly. So we had the expense but did not pay any cash.
Yep. Debit expense, credit the payable, no cash impacts. We've got to add that back because there was a loss.
And reduce net income, but cash didn't actually go out, so we want to put it back into net income. Other current liabilities we have moving in the opposite direction there, where we've used some up.
Could be income taxes payable right now. We just debited income taxes payable, credited cash, so no impact on net income, but we do have to, we got rid of the cash. We got to show cash going down.
Do you see how it's all fitting together? All the journal entries and everything that we've done all throughout. It's
awesome.
I like it.
I like this one. Yeah, totally.
All right, long-term debt. It looks like we went up in debt an extra $300. So
yep. We got some cash. We issued some debt.
Got the cash. Issued some debt. Common stock, same deal there, right?
Probably some stock compensation. We gave some restricted stock or something like that to our key employees.
Maybe they exercised some options, right? Gave us some cash for that. $150 going up. Retained earnings, we're going to skip that one again because remember we're breaking out right below with net income, dividends paid.
Yeah, so I mean maybe when you look at this, you can see retained earnings went up by $1,400. Net income minus dividends, that's $1,400 right there. So that's what.
Is that going to work out the same way every time?
I hope so. Unless there's something else funky going through retained earnings. So if it's just net income and dividends, I hope it works every time.
So net income, Boz, you're going to take $4,700 minus $4,500.
Am I going to? Oh no, I see what you're getting at there. This is now an income statement, a current year item. So we're just going to take that entire $4,700 and that's going to be the first line on our operating activity section.
Step 1, right? And then dividends paid.
Again, that's not like a dividend payable account. That's not a balance sheet. That's not a change. We actually paid $3,300 in dividends last year. Last year we paid $3,000. So we need to show a full $3,300 decrease in cash flows this year.
Yeah. So now that we're off the balance sheet, everything up above, we're just looking at the difference for balance sheet accounts. But now that we're off the balance sheet, right, net income, we're going to have in our income statement, dividends paid, statement of stockholders' equity. We can just take that actual dollar amount at that time. So depreciation expense, that's going to be another one that comes straight off the income statement. So we just take the $1,050.
Debit depreciation expense, credit accumulated depreciation. It reduced net income, but it did not reduce cash flows. So it should be a positive.
Add it back. Purchase of equipment. How about this one?
Debit equipment, credit cash. So, but there's no impact on income, but cash did go down. So that's got to be a negative.
There you go. Negative $2,050. Purchase of investments.
Debit investments, credit cash.
Negative $500 and sale of investments.
Yeah, we'll assume they sold them at no gain or loss at that point in time. So debit, cash, credit, investments.
And if they were to sell them at a gain or loss, we'd have that same situation where you back it out, do the opposite of whatever it is in the operating section, and put the whole cash amount received in the investing section.
Exactly.
All right, Boz. 3 C's, step 3.
So we already did
Categorize.
and then we did calculate. And now we're going to do
create.
We didn't practice that.
Wow, that was pretty good.
Yeah, it actually wasn't that hard, so we'll take credit for it.
And now that we've done, what is this, number 11?
Yeah,
11
right.
of these are getting better.
That's right.
All right, so we have all of these different activities. We already classified them into operating, investing, and financing. We figured out the amounts. So really the last step, you just combine the two, break them out into their different sections, add up the total amounts, and you can see that we have net, if we take $4,400 that we had from operating activities, the negative $2,300 from investing, the negative $2,850 from financing, that adds up to net a negative $750 in cash. And if we go ahead and add that to our beginning, we get an ending cash of $3,950, which should equal.
And that did equal our balance sheet. Yep.
There we go, $3,950 in cash. Whew.
And just one thing, just to prove it out, right here, don't look at the subtotals, but if you just look at the components, we have 8 components here in the operating activities section. We have 3 in the investing. We have 3 in the financing activities. So those are kind of 14 individual components. And if you went back here in this amount column, you would count 14 individual components. So that's what we've used. We just kind of went through those sections just in order with how it was labeled there.
Cool. Good work.
All right. Well, now what do we do? Are we done?
Do you think we're done?
Sure. I need my nap.
How would you analyze this, Boz? What do you think looking at this one? It's a lead into our next point.
And again, we say analyze. We're not saying, hey, it reconciles, okay? Because
woohoo, it works.
It works.
We did
done,
it
right? Because in the real world, you got software. This thing will just be done automatically. So in the real world, the beauty is really in analyzing this. Well, as I look at it, I like it when a company has cash flows from operating activities. All right.
One of the key things I look at before investing in a company, are they actually generating cash with their operations?
Yep, because if they're not, that's a problem. And then, what they're doing with the cash from the operating activities, they're using it to purchase equipment. And honestly, I like that because that means they're probably expanding their business.
They have plans. Right? They're not just sitting still and, okay, we're going to take it and leave it and move on,
Totally. And then they're also paying a lot of dividends to the owners as well. So they're not repurchasing any stock, but they're still returning cash to the owners via dividend payments. This is flat. This is just square on, flat out, healthy company. Cash flows from ops, using it to expand their business and give some cash to their owners.
Do you know who I loosely base this example off of, Boz?
Honestly, I have no idea.
I asked
him told me you were going to say this.
You got all sorts of fired up. He told me it was a dumb question.
Trinka does not have that much cash flows from operations yet. And I was like, we used Best Buy at the beginning.
That's a good guess, but no, this is actually Costco.
Oh, Costco.
Costco.
I like Costco.
And I
one
edited a lot
of the
of
top
different
ethical
things,
companies in America.
Exactly.
And they have nice free samples too.
Yeah, it's actually a behavioral finance thing.
Oh, that's true.
We'll get into that in a little bit. But anyway, actually not in this podcast or in this video here. But let's look at some keys of how do we actually interpret a statement of cash flows. So
we talked about what we just said, but we'll just a little bit more detail.
Jumping through the operating activities section first. So mature companies, we're looking at higher than net income. Basically, we want to see cash from operating activities to be greater than the net income item. The thought being that a lot of depreciation amortization is going to be added back, which is going to reduce that net income
figure.
So large decreases. 1 year or 1 quarter, not as big of a deal, but if it's over and over again, why do we have these large decreases? Something that I would expect executives of a company to answer on an earnings call or something like that.
Yeah, I mean, you can see like if you had a large increase in accounts receivable, that would show up then as a decrease on your statement of cash flows. So it's like, did they just sell a bunch of stuff on account, maybe to customers that might have trouble paying or something like that? Then we'd probably want to dig into the bad debt reserve. Have they reserved enough for that, or what's been going on?
Points you in the right direction, right?
Yeah. Or if there's a large increase in inventory, well, is the inventory not selling? You know what I mean? Are they just stockpiling inventory?
Is it forecasting something that's going to happen poorly down the road? Let's move on to investing activities. So in general, if a company is going to expand, we're going to have a negative investing activities, mostly driven by property and equipment. But if it is positive, because they sold some property or they sold some investments, you would probably want to figure out why. What are they going to do with that cash that they received from the sale of their property investments? Are they going to give it back to shareholders, or are they using it to cover up some other shortfalls in their company?
So like Best Buy, the initial example, they had a positive cash flows from selling investments, right? But I think that was probably just excess cash that they invested in government bonds or something like that. And then they bought them last year and then they sold them this year. That's fine. But let's say Best Buy had a bunch of cash flows from selling their stores. They all of a sudden sold all their Best Buy stores in order to generate enough cash to stay afloat and pay back debt. Well, you don't have any Best Buy stores. Now you don't have any operating activities left anymore, right? So would be a cause for concern.
Absolutely. And then the next one, cash flows from financing activities. A lot of times, if it's a newer company, going to be a lot of inflows coming in. They need to raise capital to finance some of that expansion. They got to pay for it somehow, some way. But if it's a mature company, a lot of times they're going to have outflows, and that they're at the point where they can purchase dividends, repurchase shares from investors, things like that.
Yeah. So with this one, imagine you saw a company's cash flow went up. You don't just want to look at the cash balance and say, oh, it went up, they must be fine. Because what if they had a big negative from operations, but then they took on a big borrowing in order to fund their operating losses? I mean, if that happened year after year, eventually banks are going to quit lending them money. So, and then they're going to go out of business at that point.
It's a sad day.
It would be, totally.
I don't want to end on a sad note. So,
right.
Healthy company, what we're looking for, generating positive cash flow from operating activities. And then we have an outflow in investing in finance. Outflow for investing, I like to think of that as they're reinvesting those cash from operations in their own business. Mm-hmm. And then from financing, it's they're distributing it through dividends or share buybacks, things like that.
Yeah, and that's more of a long-term point. In the short run, you wouldn't expect that. But with mature companies, you would.
Yeah, great. All right, well, let's finish up, Oz. What do you think?
I think we should do some key takeaways now. It's been a fun lesson.
Key takeaways. So, statement of cash flows used by investors to help understand how the company is generating and using the cash. Just gives you a lot more detail, right? We can look into each individual section. We can pick and choose. Different investors might even emphasize different sections. It tells us what we need to further look into about a company. We got 3 main categories: operating, investing, and financing. Hopefully by now you know quite a bit about what goes into each one. And hey, look at this, Boz, the 3 C's. Classify, calculate, and create is what we can do to give us our statement of cash flows. So with that, that's all we got for statement of cash flows. Thanks for tuning in. I hope you enjoyed it as much as we did, and we'll catch you next time.
I don't think they could enjoy it as much as we did. So
maybe we got some young accounting professors out there.
Maybe we do. Take care, everyone. We'll see you next time for lesson 12, ratios.
Woohoo! See you later.